Welcome to Daily Forex, and today the topic of the video is using volume to win 75% of trades. So let's dive into this one. For a currency to be traded and for its price to move from one level to another, volume is required. Or put another way, volume is the gas in the tank of a trading machine. However, volume has often been overlooked in the study of Forex charts, but the focus has been more on price action alone. Volume is required to move a market, but it's a particular type of volume that really matters: institutional money or smart money, which is large amounts of money being traded in a similar way, thus affecting the market greatly. Only volume shows when price is being affected by this type of activity. Knowing how institutional money operates, we are able to track those traders and trade along with them so that we're swimming along with the proverbial sharks rather than being their next meal. There is a common misconception that volume cannot be used reliably in Forex trading for two reasons. Firstly, there is no central exchange and therefore no volume data. Secondly, when you're actually looking at volume data on your Forex platform, you're actually seeing tick volume and not actual volume traded, such as the volume with the stock chart. Tick volume. So this measures the number of times the price ticks up and ticks down. This is an excellent indicator of the strength of activity in any given bar. But also, the correlation between tick volume and actual volume is incredibly high. In 2011, a gentleman known as Casper Marnie, head of Marnie Capital and ex-UBS and HSBC trader, he conducted an analysis of actual volume and tick volume in Forex. He used data from eSignal, EBS and also Hotspot. For the pairs that he studied, he calculated the correlation between tick volume and actual volume is over 90%. So the question is, how do we go about tying in volume with price action? The study of volume with price started in the early 1900s with a trader by the name of Richard Wyckoff. His research, then known as Wyckoff analysis, developed into what is known today as volume spread analysis, or VSA for short. Not all VSA traders or techniques are the same. Some are incredibly software driven and complex, whereas we like to keep it simple. The simpler the approach yields results. Experientially speaking, a success rate of 75% and more is not uncommon with very few consecutive losses. A simpler approach is reflected in the charts. We have a price candles, volume bars, and that's it. We use the 50 and 61% Fibonacci lines and simple support and resistance to help pin entries, but nothing more. So to summarise, 1. Institutional money or smart money is necessary to move a market and is revealed in those volume bars. 2. Forex tick volume can be read as an accurate indicator of institutional or smart money strength. 3. VSA, so volume spread analysis. When it's kept simple, it can be applied and taught more easily with win rates of 75% and more. So thank you from Daily Forex. Please do not forget to download the Daily Forex app for all of the latest market analysis and educational videos. Thank you.